If you are holding StarHub in your portfolio right now, you probably felt that pit in your stomach when the earnings notification popped up on your phone. A massive 35.3% drop in net profit. That is the kind of number that makes you want to panic sell immediately. And if you are looking at Frasers Property, you might be confused. Profit is up nearly 18%, but revenue has crashed by almost 20%. It feels chaotic out there. If you are reading the headlines today, it looks like the Singapore market is struggling to find its footing, with major blue chips signaling distress. But if you strip away the one-off accounting adjustments and look past the scary headline percentages, the real story isn't that the market is crashing, it is that the market is splitting. We are seeing a massive divergence. While the telcos and tech manufacturers are bleeding, there is a quiet, massive boom happening in commodities and aviation that most retail investors are missing because they are too focused on the losers. The real decline in the tech sector is concerning, but the resilience in other sectors is offering a clear roadmap for where the smart money is moving. I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise, ignore the clickbait, and show you what really matters for your CPF, SRS, and SGX portfolios. And we have been putting in the work to make sure you are ahead of the curve. Since October 2025, this channel has produced over 200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context, so you can uncover hidden gems and potential pitfalls. Today, we are going to do exactly that, with a deep dive, slide by slide, through the latest earnings season to see who is actually making money in this economy. First, let's look at SATS. If you have flown recently, you know Changi Airport is packed. But as investors, we don't rely on anecdotes. We rely on the financial statements. SATS delivered what I would call a textbook recovery quarter. Net profit rose 13.3% to 78.9 million Singapore dollars, and revenue advanced 8.4%. Now, let's break down why this matters. SATS is what we call a proxy play. When you buy SATS, you aren't just buying a catering company, you are buying a proxy for the entire aviation recovery theme without the fuel risk that an airline carries. The key data point here is the contribution from the cargo segment. Why is this important? Because historically, SATS was heavily reliant on passenger meals, but this result shows resilience in cargo volumes. This provides a buffer. If passenger travel dips slightly due to a recession, cargo often keeps moving. SATS is benefiting from a diversified business model that taps into air freight and logistics. For us as Singapore investors, this is exactly what you want to see. A company that has pivoted to becoming a global air cargo leader rather than just a local kitchen. The recovery is real and it has legs. The question you need to ask yourself is about valuation. How much of this good news is priced in? SATS is no longer a distressed value play. It is a growth momentum play. Now let's pivot to the technology sector, where the picture is much darker. We need to talk about Venture Corporation. This is a blue chip manufacturing counter that many Singaporeans hold for dividends and stability. But this quarter was a warning shot. Net profit fell by 8.3% to $55.6 million, and revenue dropped by 9.1%. Let's define what this means. When revenue and profit fall together, it indicates a demand-side shock. It means fewer people are ordering the electronic components Venture makes. This isn't just about Venture having higher costs, it's about their customers, the big global tech firms, slowing down their orders. This signals that the global appetite for electronics and tech manufacturing is softening. This is what we call a cyclical downturn. The flat share price movement before this announcement tells me the institutional money already knew this was coming. Iggy's perspective here is caution. This looks like a speed bump for the entire tech sector. Until we see a reversal in that revenue figure, Venture is a watch, not a buy. We need to see evidence that this is a company-specific issue and not a sign that the global economy is hitting the brakes on hardware. Moving on to property, we have a very tricky situation with Frasers Property. This is where you really need to put on your analyst hat. The headline says profit jumped 17.8%. That sounds amazing, right? But if you dig into the slide, you see that revenue dropped significantly by 19.2%. How can profit go up if sales go down? This is the concept of non-operating items. The profit boost came from changes in property valuations and one-off tax reversals. Let me explain this simply. If you own a house and the market says your house is worth $100,000 more today than yesterday, your net worth goes up. But you didn't actually make any cash. You can't spend that valuation increase at the hawker center. That is what happened here. It's an accounting lift, not real business momentum. The drop in revenue signals weaker core business activity, slower property sales and leasing. For income investors, the proposed dividend of 4.5 cents per share is a bright spot. It offers yield. But you have to be careful. Dividends paid out of accounting profits rather than cash flow can be risky in the long run. My take is that this is a classic accounting puzzle. The falling revenue is the real number to watch. It tells you the actual business of selling properties is slowing down. Do not get seduced by the headline profit number. Look at the top line weakness. Now, let's shift gears to the standout winners, the commodities sector, specifically palm oil. We have two major players here, First Resources and Bumitama Agri. First Resources reported a massive 43.5% surge in net profit. Bumitama posted 29% growth. Why is this happening? This is the power of operating leverage in a commodity upcycle. These companies have fixed costs, the land, the trees, the workers. Once they cover those costs, every extra dollar increase in the price of palm oil goes straight to the bottom line. Elevated global demand and firmer prices have translated directly into profits. This is the reward for investors who stuck with the commodity cycle. However, a word of warning from my desk, commodities are cyclical. They are price takers, meaning they cannot control the price of what they sell. The market dictates it. Prices can be volatile and sensitive to policy shifts or weather patterns. While the current run is fantastic and these stocks are cash cows right now, you must monitor for signs of a reversal. If palm oil prices drop 10%, their profits will drop by more than 10% due to that same operating leverage working in reverse. But right now, they are the clear winners of this earnings season. On the flip side, we have the telecom sector and specifically StarHub. This was a tough quarter. Net profit tumbled 35.3%. Revenue decreased by 4.3%. The company blamed a drop in gross profit. Let's analyze gross profit in the context of a telco. This usually means they are facing increased cost pressures or they are failing to sell their high-margin services like enterprise solutions or cybersecurity effectively. The Singapore telco market is saturated. It is a battleground. You have MVNOs like Simba and Gomo fighting on price, driving margins down for everyone. StarHub's results show that the competition is hurting them. From my perspective, StarHub is currently a show-me story. Management has yet to unveil a convincing turnaround strategy. Is the problem intense competition or are customers simply spending less? Until they can demonstrate a clear plan to boost margins or launch a breakthrough offering that restores pricing power, this stock feels like a risky bet. It is speculative at this stage, and for a defensive dividend investor, speculative is not a word you want to hear. Finally, let's look at a defensive play that is actually working. Centurion. They focus on worker and student accommodation. Revenue grew by 9%. Why did revenue grow? Management cited the ability to raise rental rates. This is the definition of pricing power. In an uncertain economy, people can stop buying new iPhones, bad for venture, and they can stop upgrading their data plans, bad for StarHub. But they need a place to sleep. Worker dormitories and student housing satisfy an essential need. Demand is inelastic. This resilience is notable. For investors, Centurion represents a true defensive mode. It's a stable anchor. If you are worried about a recession, you want to own companies that provide essential services. The fact that they can raise rents in this environment proves they have the upper hand. It's a boring business, but boring is beautiful when the market is volatile. So, where does that leave us? How do we summarize this mixed bag for your portfolio? Let's look at what is working. The balance sheets of the commodity players are fortresses right now. Cash is pouring in for First Resources and Bumitama. The travel recovery theme for SATS is valid and generating real cash flow. These are the engines of growth in the current Singapore market. What is not working? The old guard of telcos and pure play tech manufacturing is under pressure. They are facing structural headwinds, saturation for telcos, and a cyclical slowdown for tech. Relying on them for safe, stable growth is becoming a dangerous game. Regarding valuation, the STI is currently a market of stocks, not a stock market. You cannot just buy the index and hope for the best. You have value traps like Frasers Property. where the low PB ratio masks revenue declines. And you have momentum, plays like SATS, that might look expensive but are growing into their valuations. Here is my final recommendation, split for those of you already in the market and those looking to enter. For existing unit holders of SATS and the palm oil players, hold. The momentum is with you. The yield on the planters is decent, and the capital appreciation on SATS has room to run as aviation fully normalizes. Ride the wave, but set a trailing stop loss to protect your gains in case commodity prices turn. For existing shareholders of StarHub and Venture, you have a tough decision. If you are holding for dividends, check if the payout is sustainable with dropping profits. I would personally look to trim these positions on any small rally and redeploy that capital into sectors with actual tailwinds. For new buyers, wait, the risk reward for the broad market isn't there yet. I would avoid the telcos entirely until the price war ends. If you are looking for entry points, I'd wait for a pullback in Centurion to get a better yield, or wait for a dip in SATS. Do not chase the green candles. Patience is your edge. If you found this analysis valuable and want to go even deeper into these numbers, consider becoming a free or paid subscriber to the Investing Iguana Substack. We don't just skim the surface, we dig deep like we did today every single week. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We're also thrilled to welcome our growing community of over 30 YouTube premium subscribers and 19 paid Substack members who make this in-depth independent research possible. You guys are the real MVP, keeping us independent and ad-free from corporate sponsors. Thanks for watching. Check your portfolio, don't panic at the headlines, and I'll see you in the next analysis.